Hi, and welcome to Midas Investing. Today, we're going to be taking a look at ASML Holdings, ticker ASML. This company has come into the limelight recently as one of the most important companies in the photolithography industry. In particular, ASML has a virtually 100% market share in the extreme ultraviolet device manufacturing space, with a huge amount of relevance in some of the other deep ultraviolet device manufacturing as well. But with this company's importance and its seemingly unassailable competitive advantage, as well as concerns surrounding supply chains, especially within the chip space, a lot of people have been turning their attention to this company both in terms of its valuation and its operations to see what the future holds for it. So let's take a look. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So hopping right into their annual report, I come down to this page a little bit down in the report where they talk about Moore's Law. For those who aren't aware, photolithography is essentially the process of using light radiation to etch intricate patterns into chip wafers at a near microscopic level. And Moore's Law, it describes the process by which we've been able to guide chips to a smaller and smaller size over time at a relatively consistent rate, given the last several decades. There's been a lot of questions about whether or not this process could continue into the future, but so far, at least for when it comes to the most recent developments in technology, we at least seem to be able to push the boundary a little bit further. I wanted to hop into this equation right here that I talk about, the Raleigh criterion, which basically describes methods by which they can get this process a little bit smaller and lower. Particularly, we have this ratio right here where we have this lambda signal being divided by NA. Now here they designate the lambda as being the wavelength of the light that's being used within the device. So obviously you could always try to narrow in on a much more specific band of radiation at a smaller wavelength to essentially guide to a smaller chip size, which is essentially what the output of this equation is trying to get us to, the critical dimension size we're getting to. The idea is you can use a smaller wavelength to get this smaller, and that makes sense. But you could also use a larger aperture size because we're dividing by this aperture size, which that's what NA stands for, is the numerical aperture, which is essentially the lens through which the light you're shining it in. So essentially there's two ways by which we can do this process. And for the most part, over the last several decades, the general guide has been to get the wavelength lower. And in the most recent couple developments that ISML has gone through, which is to switch between their EUV 0.33 NA device to now up to a 0.55 numerical aperture. They've essentially gone from trying to get the wavelength smaller and smaller to now working with the aperture lens itself to essentially work on the other end of the equation, trying to guide this process lower. I spend the time to talk about this because I think that it's at least important to understand the general process by which they're trying to improve their machinery over time. I'm not an expert in this technology at all, and very much the rest of this presentation is going to be much more about the operations and the numbers of their business and the valuation, stuff like that. But for the most part, investing in this company, it is a technology company. So I think it's important to at least have an idea of how it is that they're going to improve their devices over time if they're going to be able to maintain their competitive advantage going forward. So sliding up a couple pages up ahead of that slide, I wanted to talk about that first before getting into this, but now we can kind of talk about the different sets of products and services that they have. We were just talking about their extreme ultraviolet machinery, and particularly the 0.33 aperture devices, and then their more recent, highly developed high numerical aperture devices, the 0.55 devices, which are essentially the next generation of their photolithography equipment. But beyond those, which are more the flagship devices, the particular space in which they have the largest market share, they then also have another set of other segments. In particular, they have their deep ultraviolet lithography systems, which are generally seen as more of the workhorse of the semiconductor industry, a much larger wavelength of light, whereas the extreme ultraviolet systems have wavelength of lights down to 13.5 nanometers of light. The deep ultraviolet systems are operating at wavelengths of a few hundred nanometers, though they have different stages and different forms of it. And then they have different forms of these DUV systems as well. They have an immersion type system where they are using the larger using the larger wavelength of light, but then they use a thin layer of liquid to essentially adjust the aperture lens using that liquid, because obviously water has a refractive effect on light. And then they also have a dry system, which allows for a much thinner aperture because not every chip has to be at the most cutting edge, obviously. And then beyond just those devices that they sell, they also have metrology and inspection systems, which are devices that they sell for testing the quality of the chips that these devices themselves produce. So they have the ability to manufacture devices, but then they also sell to their customers the ability to test these devices and make sure they're up to the high quality that is expected. And then beyond that, they also have a large amount of the revenues coming from systems and support services, where they themselves send in techs to maintain, adjust the devices and keep them up to stuff over the decades. These devices tend to last for a very, very long time. And in fact, the vast majority of the devices that the company has sold over many decades are still out in force in the field. In fact, we'll somewhat get into some details related to that in when we build up the valuation. Now, I also wanted to take a moment to talk about their space within the industry and within the supply structure in general. They operate within the chip space, but the chips are used obviously for a wide variety of devices, whether it be smartphones, personal computing, personal electronics, automotive, industrial, all the other categories that they have listed here. But they break down these different markets in terms of the actual chips usages by size, with the 2022 market size historical measure, as well as projections for 2025, 2030, and then the overall projected CAGR over these periods. So in general, the point is they're trying to show that these devices overall demand is moving forward, and whether or not ASML is the person that's selling all the semiconductor manufacturers the equipment that produces devices is a separate question. But the point is that at least the core demand for the products that are being manufactured with their products is going to be, continuing going forward. And then one other thing I think is core to mention that is, yes, we have a 9% CAGR for the demand of the chips themselves, but that doesn't really say anything in particular about the subsection in which ASML operates. Their extreme ultraviolet machinery, as I said, they have basically a 100% market share within that space because they're the only ones that are selling those types of devices that are at the most bleeding edge of the technology space itself. So while there's a lot of other people that manufacture devices that can operate some of the lower end chips below them, that doesn't mean that there isn't going to be probably a higher CAGR of people trying to filter into the higher level technologies, even as newer technologies are being developed over the decade. So I would actually almost look at this 9% as like a baseline, a minimum, if you will, let not an expected level of growth for the company. And coming down further in the presentation where they talk about their growth opportunity, they actually have this really useful table over here where they give pretty solid projections for basically their whole business going forward into the future. They have both a high and low, a bull and bear case essentially for projections of system unit sales within different segments of their business, both the high aperture EUV as well as the low aperture EUV, as well as their immersion and dry DUV space, and giving up to the total. And then, like I said, these are listed in terms of units, is both a 2025 number and a 2030 number based off of their presentation day in 2022. And then they also compare that to their previous projections that they had made in 2021, only a year prior to that, essentially showing that even under their own projections, they're upgrading to more bullish assumptions all the time, which is, who's to say, maybe in 2023 or 2024 they would up these projections even further. We'll have to look forward for that going forward. But nonetheless, the point is at least of 2022, they have estimates for 2025 and 2030 for all these different segments. And then not only just the system units that they expect to sell, but then they essentially compile this, aggregate this into expectations of the total sales opportunity, both for systems, which includes their metrology and inspection segment, as well as the installed base management services, as I was talking about, essentially giving us a total sales projection for those years. As I said, both in a bull and bear case. When I'm building up my model for the company, we are actually essentially just going to take these numbers for granted, which in general, you sometimes want to be a little careful when you're making assumptions based off of the projections that a company gives you. But as I was just hinting there, we've seen that they've actually upgraded their projections over time and giving me at least some reason to believe that they're reasonably conservative before they start upping these projections. They tend to wait and see that there's a little bit more confirmation that the market is as hungry and has the appetite for their devices that they see in the past going forward. But the point is as I already stated, I don't consider myself some expert in technology in particular. So I'm not going to pretend to have some better idea of a demand for these devices than they themselves say. And instead, we're just going to work backwards from the assumptions that they list in this table, put it into our model, and then basically fill in the blanks for some of the other areas that they didn't give us, and then try to work from there. It's worth noting that in this text section, they also talk about expectations of possibly hitting gross margins between 54 and 56% in 2025, which is pretty relevant to making projections for their margins. And also worth noting that all the numbers here are listed in euros, billions of dollars of euros, which in general is how they list all their information. So if you're reading this, make sure you're at least noting that. All right, so coming right into the spreadsheets, take a look at some charts to kind of explain the operations of the company over their most recent decade. Right here, we have with the bars, the systems sold in each year. The total systems doesn't really matter which particular segment, whether it's the extreme ultraviolet or the deep ultraviolet, or even the metrology and inspection devices. All the systems sold are included in this number, just in general to show the general expansion of all of their sales by units over the time. And then the purple area that we have in the background is an estimate of the cumulative units that they have based off of that. Now I say an estimate because I essentially only had 1 year where I could get a particular solid number from them of what it was in that particular year. And instead I just had estimates in some other areas. And then I essentially chose to work backwards, subtract out the units sold in each year to get the more historic trend in the background. And then in general right here, what I have with the line placed against that is the percent sold as a percent of the cumulative. So you can get an idea of essentially how much of this year's business compared to their total business and do they actually have. And in general, you can see that that percentage has actually been rising over time, you know, a little bit ups and downs in general, but it was in kind of the mid single digits and it's moved pretty solidly into double digit territory, showing that their sales are actually accelerating. It's like, yes, they have a really large amount of already installed bases, which is why I showed this area right here, as I was saying before, at one point, that they have the vast majority of the systems they've sold are still out in the field. In fact, they estimate that about 95% of all the units that they've sold are still being used out in the field, just showing you in general the longevity of these devices, especially when they've been carefully serviced over time. But that's why I think it's important to get an idea of just how much of their total sales that they have out in the field are of the most recent purchases, giving us an idea of the growth of their demand over time, not just saying, oh, well, they actually sold a whole bunch of stuff in the past and that's really why they're prolific. It's like, no, 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 they're actually becoming more and more prolific. And you can see that with this ratio. Then coming over to this next chart, we actually then take the revenue distribution, the total revenue of their company, and then split it off into the different segments that we were talking about. In the orange, we have the extreme ultraviolet devices. As you can see, that's the part that's really grown into its own over the last decade and become basically a pretty large lion's share of the business itself at about 33% of the sales in 2022. And then we have the immersion deep ultraviolet devices, which was the previous kind of lion's share of the business, still a pretty hefty chunk of the business in general, but as you can see, the more advanced devices have really started to take off. And then below that, we also have the dry deep ultraviolet processes as well, and the metrology and inspection segment, which you can see the metrology and inspection segment has actually started to grow a little bit as well, which would make sense because as we were talking about, those that particular segment is kind of meant to be a counter after effect to the other processes. Those are meant for testing the results of these processes themselves. And then below that, we have the services revenue, which you can see in general, even over the whole decade, has made up a pretty substantial portion of their business. As we already talked about, they have to service their devices in order to keep all those devices well functioning in the field as long as they've had, which kind of allows for a little bit of a diversification of their revenues away from a little bit more of the cyclical capex purchases that these devices typically make up for most companies, and to become into a little bit more of a consistent flow of cash, almost like a subscription model to a certain extent for these equipment devices. So now let's come down into the individual segments one by one to take a little bit of a look at some of the components that make them up. Here, first, we're looking at the EUV segment, and the backdrop we have is the total system sold across all of their segments. So this is the entire amount of their system units being sold. And then the small bars next to that is the actual EUV systems being sold by year. So giving us an idea in terms of volumes, how does that compare? We already saw that the EUV made up like 33% of the revenues. But as you can see right here, it makes up less than 10% of the total units that they sold in 2022. Was that like 7 to 8% or something like that? Just showing that, wow, 33% of the revenue comes from 7 to 8% of the total units that they're producing. Well, firstly, you have to take into account the size of these machines. These are some massive, massive machines in the first place. So maybe if we scaled it by weight of the units, then maybe they would actually start to be a little bit more appropriately measured. But the point is that there's also the dollar figure associated with each of these units, which we have the dollar per unit in the red line right here, showing that even 10 years ago, those devices were over $60 million on average each. And in the most recent year, they're over $170 million per unit. So you can see that, yeah, even if you only sold 40 units at $170 million per unit, you can really start to crank out the revenue just off of that alone. Oh, my bad. Euros per unit, not dollars per unit. And then coming over to the immersion segment, using effectively the same sort of approach to looking at it, we have the total system sold right here. You can get an idea of how that compares to the overall volumes that they're pushing. The immersion unit being a little bit more than we saw previously, but still relatively small. That's basically double the EUV in terms of total units, but still a pretty small portion of the overall amount of system units being sold into the field. And then looking at the dollar price tag being attached to it, or the euro price tag, man, I'm doing that over and over again. It went from 40 million euros per unit back in 2013 up to about 65 million euros per unit in 2022, showing that, these are still some pretty advanced devices themselves. As we were talking about, the immersion segment itself was a little bit more of a specialized version of the deep ultraviolet, not exactly the most voluminous of the workhorses of the industry, but still pretty hefty price tag associated with it. Then coming over to the dry segment within the DUV space, we have similarly, you can see right here that made up a much larger portion of their overall business back in the early years of this last decade, then becoming a smaller segment, but still making up a much larger portion of this actual total system sales, that being more like 30 to 40% range. And then the price tag per unit was relatively consistent. We can see right here that over the whole decade, it really didn't go up too much. It went up a little bit, but not necessarily a crazy amount, and actually had some periods where the price seemed to be languishing a little bit. But still, in the most recent year, up over 10 million, a little bit over 11 million euros per unit. Then coming over to the metrology and inspection, you can see that the metrology and inspection started off relatively small in terms of the total unit sales or at the start of the decade, but then quickly grew to make up a much larger section of the business. And I'd say that makes sense. Essentially, as we were talking about, these are meant for testing the quality of the actual outcomes of their photolithography machinery. And as they become a much more dominant player within the space over the last 5 to 7 years or so, that means that there's going to be a lot more of these devices needed out in the field. Of course, you could always use another company's devices for inspection, perhaps, but better to match it with the company that you bought it at. Then taking a look at the price tag for these particular devices, these are definitely much cheaper devices. They're, just testing devices, not the actual manufacturing devices. So a price tag coming in between the $1 to $3 million range over the course of the decade makes sense, with a little over 3 million euros per unit in 2022. Then last but not least, we still have to talk about the services segment. Obviously, services aren't being sold by unit, so we have to kind of think about them in a slightly different way, which is why I had, in that first slide, shown the estimated cumulative units that I had taking essentially the number that they give me in 2022, and then working backwards from the units sold to get a measure of the total units that they have out in the field. Now, they themselves in the presentation mentioned in 2022 how about 95% of all the units that they had out in the field were still out in the field. And so I could use that ratio to adjust that measure to get a more accurate reflection of this estimate. But then I could use the services sales to essentially say, okay, well, the services are not about the units being sold this year, right? They're about servicing all of the units in the field. So I said, okay, let's take the services sales and then find out how much dollars of service are they earning, or euros per service that they're earning per unit that they have in the field. And that right there, you can see has risen from a little over 600,000 euros per unit back in 2013. Over the course of the decade, had a little bit of a slower growth rate at some of the periods during the decade, but then taking off after 2019 during some of the higher inflationary years to well over $1 million per unit out in the field for services. All right, so now coming down into the spreadsheet to take a look at the model that I built for the company, using all the data that I just talked about in the charts listed right here with the systems sold, and then all of it broken down into each of the different segments as I talked about, and then the price per unit worked backwards into that. And then I also have the services sales as I had described, and then the amount of services euros per unit out in the system that they have. Now, as we talked about in that table that they gave in their presentation, they give us pretty specific estimates for the units that they expect to sell in their their bull and bear cases for the different segments. So essentially, I just took those numbers as given in terms of those sales, and I also took the total system sales, which they had given us as a given, and then I worked backwards from there to essentially try to make an estimate of how many dollars per unit that implies for each of these categories. Now, I did have to make some sort of assumptions about that because the point is we don't really know how each of these segments are going to grow relative to each other, since they only gave us an estimate for the sales by the total system sales rather than by the units themselves. So what I chose to do is essentially assume that the price per unit for each of these segments is really going to grow at basically a constant rate within the different segments themselves, which is not true across the historic period. In general, we can see like right here we have 12 to 13% CAGR for the price per unit for the EUV space, 4.5% per unit for immersion, 1.5 per unit for the dry, and 7.9% per unit for the metrology and inspection. So like 4 different units, 4 different growth rates, and I chose essentially just to assume the average between all 4 of those, which was about 6.6%. I chose to just assume that the price per unit for all of these segments and in the bull and bear cases were going to basically consistently grow at that 6.6%, which again, that's a huge assumption, probably not necessarily true, but again, we already had an endpoint for the revenue here. So it doesn't really affect the revenue numbers. The company already gave us the revenue numbers for the system sales. We're essentially just taking the revenue numbers that the company gave us as given, and then we're working backwards to see whether or not the assumptions that that implies is comfortable for us or not. So this is a little bit different than some of the other valuations I usually do, where I'm trying to build up to a revenue number. In this particular case, I was literally given the revenue number to start with. And I'm essentially working backwards to say, am I comfortable with the assumptions that these revenue numbers imply? So looking at that, then I say, okay, well, then the implication is that the EUV segment is going to go from 40 units sold per year to anywhere from 80 units to 110 units sold per year. And they're currently selling for 176 million euros per unit. And based off of that implication, it would be selling for about 334 million euros per unit. So am I comfortable with their price per unit essentially doubling to possibly over 300 million per unit during that time frame, while assuming that the units that they're going to sell are essentially going to double in a half? For the EUV space, considering the bleeding edge of their technology and the competitive advantages that they have within that, I actually am pretty comfortable within that. And also, especially given as we were talking about, even as the chip space grows around it, more people will likely be trying to concentrate into the previously considered state-of-the-art technologies, even as new state-of-the-art technologies are being developed. And then likewise with the immersion space, we previously were at 81 units sold in 2022, and their assumptions have us going from that to on average maybe about 100 units sold per year in 2032. So a much smaller segment of growth for the units for this particular segment. And then with that, we are assuming that the price per unit itself is also basically going to be doubling to about 123 million euros per unit. Now, that is a still significant amount of price per unit growth, but again, we also saw that the units weren't going to grow as fast for this one. So even though it's at a lower technology space, I think that's a better bit of conservatism in terms of the unit growth, especially considering this is still some of the higher, more state-of-the-art technology compared to some of the other ones. Then we have the dry space, which is expected to grow itself pretty consistently, but maybe about 50% over the entire time frame, somewhat similar levels of growth for the immersion space. And then likewise, are we comfortable with assuming that there would be approximately a doubling in the price per unit for that space? I'm less comfortable with that one, but considering it's also still has much smaller unit growth, then I'm reasonably comfortable with that as well. Then, last but not least, we have the metrology and inspection segment, which I had to make a little bit of a separate extra assumption for this segment compared with the other ones, partially because the company gave us unit projections for the other 3 units, but they actually didn't give us unit projections for 2025 and 2030 for the metrology and inspection. So I used the system sales and then used essentially the leftover of what wasn't included in the other assumptions to essentially leave what was left over for the metrology and inspection. So what that did give me was a different estimate for the bull and bear case for the amount of units that would be sold for each, on average about 150 units for metrology inspection compared to the 216 units that they sold in 2022. So we would actually see a decline in total units being sold implied by the assumptions that the company gave us for metrology and inspection. But considering this is a smaller section of their business that essentially is an addendum added on to the sales of their previous devices for maintaining the devices, and also checking the quality of the chips that they put out, I feel a little bit more comfortable with some weirder assumptions assigned to that. But nonetheless, if you put all those together, like I said, it adds up to the already given assumption that they had for us for system sales of about 33 billion euros in the bear case to 47 billion euros in the bull case. Then they also did give us the service assumptions of about 11 billion and 13 billion respectively. And then, as I had said before, we can then work backwards to figure out what the total amount of service euros per unit out in the field. And then I did add up all of the units that are being sold over the course of the decade with these projections, and then added on to the previous estimate of cumulative units to get us to about 9.6 thousand to 10.7 thousand in our bear and bull cases, respectively, for 2032. And then based off of that, that gets us an implied amount of service dollars or service euros per unit of 1.1 million to 1.2 million, which is remarkably close to actually the level that we have in 2022. So I feel pretty comfortable with that assumption as well. So then those then add up to the total revenues given by the projections of the company in 2030, 44 billion euros to 60 billion euros. Though, as I just said right there, that technically is their assumption for 2030, and I'm applying that to 2032. So you could add that as a small measure of conservatism within this model. Now, coming down, I also chose to include the cost of systems and the cost of services that they had listed within their financials separately, since manufacturing devices and giving services usually have very different cost structures. I figured let's make sure that we're tracking the expenses over time differently for the growth of these different segments. And then I chose to apply essentially assumptions close to their longer term averages, in particular for the cost of systems, assuming that their longer term average in terms of their bear case would apply, and then maybe adding one standard deviation to that in their bull case estimate, under the assumption that Moore's law is going to drive better cost efficiencies over time. Again, they themselves had assumed that they would be getting to what was it, a 50 to 56% gross margin assumptions in 2030, whereas I myself am assuming a much more conservative number than that. But then with the cost of services, I chose to actually assume that they could have even larger amounts of cost efficiencies applied to them, assuming that even in the bear case, they would have at least one standard deviation of improvement, and then possibly a second standard deviation of improvement for the bull case, getting them to much higher gross margins for those services. But nonetheless, the overall combined gross margin that I get for the combined systems and services is between 46% and 56% for the bear and bull case. So, like I said, compared to the company's own assumptions, you could assume that I'm actually being somewhat conservative there. Then I chose to also rely on historical averages for their SG&A sales, and we don't count R&D costs as operating costs. We choose to capitalize R&D costs in our valuation, so I didn't actually include that in the operating margin, but we will adjust for that when it comes to capital costs. But that gets me an implied operating margin in a bear case of 41% and a bull case of 50%. Midpoint getting us about 45, 46% for an operating margin in 2032. Now, lastly, before taking a look at the valuation I put together for the company, I wanted to make some comments on the overall pricing within the market. Here we have for the last decade the PE ratio and the EBIT ratio over time. You can see it's in general been at a pretty elevated level. The average for each of these being about 25 or 29 for each of those multiples. And you can see in general that it has spent a huge amount of time up in some of these more elevated levels, being up over 40 for a decent amount of time there, well over a year. And in general, when I'm looking at multiples and trying to think about like how I want the implied discount rate and growth assumptions to apply to my evaluations in the terminal year, I like to adjust for interest rates, which even if we were adjusting these average multiples that they trade out in the last decade, we would still assume that they would likely trade at something maybe around a 21 at best in terms of a terminal multiple. And even that, I think, is giving them a decent amount of berth in terms of higher pricing for future decades of growth, not necessarily the most conservative of estimates. So with that, we can come over to our DCF template and take a look at what we put together for the company. For the revenue growth, as you show right here, we can have the bull and bear cases going out to approximately our estimates within the model, give or take a small amount. All of these numbers are in euros. In the short term, we have it going roughly in line with the analyst projections. Coming over to the operating margins, likewise, we have our short-term expectations going relatively in line with the analysts, though adjusting for R&D costs because we capitalize R&D costs. So that means we have to, in general, have slightly higher operating margins than what the analysts generally are going to be assuming. But then likewise, we have it moving towards our model cases in the terminal year. Coming down, you can see a little bit of the spread between the operating margin cases as I applied and how that changes the operating income distribution in the terminal year. A pretty wide range of potentialities for that, but mostly centered around kind of around 25 billion in euros of operating income. And then likewise, we can come over to the capital costs and free cash flows to see that similarly, we have free cash flows somewhat in line with the analyst estimates for the first few years, adjusting for stock-based compensation assumptions. on average, maybe about 8.5 billion euros for the first 5 years, and then accelerating to over 13 billion euros per year for the next 5 years after that, ending at a slightly lower levels than that in the terminal case. Coming down here, you can see how we are seeing the return on invested capitals shift over time and in accordance with capital investment per year, leading to free cash flow distributions in the terminal case here in the 12 to 13 billion range. And then coming over to discount rate assumptions, as I was already just talking about a little bit ago, you can see the terminal multiple I applied to the company is in kind of the lower 20s range, but in general, that's still a pretty healthy terminal multiple to apply to a company for my valuations at least. And then that leads us to our distribution of assumptions. With the distribution of assumptions before adjusting for time value, anywhere between $385 per share and $530 per share. Although, like I said, adjusting for time value, you could argue maybe a little bit higher for all of those numbers. The median case being around $460 per share. This would be US dollars, by the way. This would be adjusted to, not in euros in that particular case. Then coming down to the fair value distribution, you can see that as it is right here, the vast majority of the outcomes, yeah, kind of in this like 400s range. With expected returns at least solidly in positive territory, though mostly in kind of the single digit range. And then coming over to the summary DCF case, you can see all the expected assumptions right here, all the numbers up at the top listed in euros. And then at some point in the bottom box down here, about halfway through, it switches to USD in equity values, thus giving us our fair value estimate in USD, comparing to the current share price in USD. And then also at this point, we've adjusted for time value. So you can see that the current fair value is a little bit higher than it was on the previous page, now listed at about $475 per share. Which, by the way, if anybody's curious what I mean by the time value estimate, so because I know some people pay more close attention to these finer details in these videos than others, it's essentially saying that in the historic data that I put into the company, I relied on the 2022 data at the end of 2022, and I didn't put the most recent quarters of information in. And I'm aware that that means my valuation as of the end of 2022 would make it slightly behind the current fair value estimate. And so I use the time value of money concept to essentially push the value forward by a little bit, adjusting for essentially the quarters that I've ignored this year in my valuation, thus bringing the value to about $475 per share. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for ASML Holdings. Very happy to finally have gotten around to this company. It's definitely been one that's requested every once in a while by a few people. It's definitely an interesting company at a very, very critical space within the overall economy, as we discussed earlier on. And so a lot of people have questions about, its valuation, considering a lot of people think of it as an unassailable moat, at least for the next decade or two from a technological perspective. But we're definitely going to be waiting for some lower prices, but it would be a very, very interesting company to possibly have in the portfolio. I'll catch you all in the next valuation. Bye.